Okay, yesterday we mentioned risk management for prop firms, and I personally believe it's one of the most important videos you can watch in terms of risk management for prop firms. But I know that a lot of you also don't really like prop firms, and believe me, you don't really have to go for prop firms. I personally believe it's a great opportunity for traders. I personally believe it's one of the best opportunities for traders. But we also need to understand that there's always other ways of doing things, right? And that is where risk management for a personal account comes in, because a lot of people, you don't like prop firms or you just want to go a more professional route. So for the beginning of my trading, we're talking like in the first 1 year of my trading, my number one goal was having a track record and then attracting investors, because that's what you do with a track record. You would attract investors or you would attract brokers to invest in you, so on and so forth. And this is where I believe that the personal account is important. Is that if you want to have your own track record, you have to do it on a personal account on a good broker. And then if you want to have growth without any limitation or some sort of limitations or profit splits, and you really just want to use your money, then that's where you also go for a personal account and you try to grow it. And so there's multiple ways to go about it. And the fundamental thought that you need to have is that it's all dependent on your skill and your goals, right? And we'll talk about the risk management for both of those things. And to me, I believe that there's a very valid point to have a personal account. And if that is something that you are looking to go for, then I would not tell you otherwise. Now, a lot of people ask me, okay, so how much should I put into my personal account, blah, blah, blah. And that is all really dependent on what you are willing to put into the personal account. So personally, I started with €1,000. So it was back then in FXCM. And my previous mentor, he would say, okay, you put an amount that you are willing to lose, but an amount that is not going to make you gamble it. And it's funny because I never thought about gambling it. I didn't know that people were literally joining a course, depositing money on the broker and trying to flip it. I have never been a guy that tries to flip accounts. And I believe that is a very, very risky business. And so for me, the fundamental thoughts are about skill and what your goals are. Now, the skill goes down into if you are an intermediate or if you are an advanced trader, or like if you are a beginner, intermediate, or advanced trader. Intermediate and advanced, they're going to be kind of similar because again, you already understand your risk management, you already understand your strategy, you already understand like everything that you might need to be profitable. But if you are a beginner, then I would only recommend one path. And that path is not going to be about flipping accounts. Believe me, I think that one of the main reasons as to why 90% of traders lose is because they try to flip the account. So you need to understand that your goal as a beginner is consistency. This should be your first goal. You have to be consistent. You have to develop your track record, not for investors, but for yourself. How do you know that what you are doing is worth it if you don't have the consistency to show for it? Right? So for me, if you are a beginner, your number one goal should be consistency, right? So that is why you should only risk 1% per trade. Now, let me explain to you why. If you are a beginner, it's fine that you are going to enter in losing streaks. It's fine that you are going to enter in a couple of winning streaks and you're going to get emotional. You'll enter in losing streaks and you'll get emotional. You don't understand the strategy well as of yet, and so you get emotional, right? So you need to understand that especially when it's your money, understand we're not talking about prop firm capital anymore, which is a whole different game. We're talking about your own money. There is no reset button. And any loss you take is actually a realized loss on your end. Because right now, you took the 1% risk, you took the loss, and you lost 1%. You can deposit that percent back, but still, that percent is not yours anymore. And so that is why it's important that for you, if you are a beginner, you risk 1% per trade. Because if you risk any more than that, let's say you risk 3%, which is going to be in this video. Let's say you risk 3%. Then all of a sudden, if you enter in a 3-trade losing streak, you've already lost 10%. That is a lot of percentage to lose, especially as a beginner. And that is what is going to trigger emotions. That is the last thing you want to do is have so much on the line that it will trigger emotions. So much on the line that you are going to be micromanaging the position. No, this trade has to play out. It has to play out. I need to go back to break even, or I need to profit to make sure that then I'm just playing with profits. If that is how you are thinking, you're thinking too irrationally. So for you, it's extremely important that you cap your risk at 1% per trade. If you take a lot of trades per week, reduce it to 0.5. But if you are going to be trading similar to us, which is going to give us around 5 trades, between 3 and 5 trades per week, 1% is very, very good. And I don't think you need to risk any less. I don't think you need to risk any more. Because once again, when you develop this consistency and you have results to show for it, you will be able to grow so much. So that is what I recommend for a beginner. That is what I did as a beginner. Believe me, when I say all of this, I'm not talking as someone that has never done this before. I've done all of this that I'm talking about right here, which is allowing me to be able to explain my experiences, right? I started trading. So in the first community that I started trading with, my first month was actually 3%. I was extremely happy. I was like, yeah, I was making great money. I actually thought I was going to make 10%. So the community was $100 a month. And I deposited $1,000 because I was like, 1,000 euros, because I was like, if I make 10% a month, I will be able to pay the bill of the course. And then, like, obviously first month was profitable, great. And then second month, -6, third month, -6. And I was like, no, I thought it was way easier. So again, that is why I'm saying that the risk 1% per trade is way better, because at the time, listen, if I would have tried flipping that account, which I never thought about, if I tried, like, believe me, if this is the first course that you're watching, it genuinely is the best course you could be watching. Because before, it didn't even cross my mind that people were flipping accounts. So risking more than 1% in my mind was like, what the hell are you doing risking more than 1%? I really didn't get it. And that is a great mindset to be in, because a lot of people that start risking more, they fall into a lot of gambling habits, right? And you'll see that your risk management on a personal account is not going to deviate as much as from an intermediate or beginner or advanced trader. So let's go into that right now. So if you are an intermediate or advanced trader, then it's going to be different, because it really depends on your goal. So your goal is either consistency and track record, or it is growth. With growth, I mean compounding your account into very high amounts. Now, again, this can go into the flipping side, but it is not going to be flipping, and I'll show you why. This is still growth that takes some time to build up. So I've talked with a couple of traders. They've been able to flip those $10,000 into $100,000, but they didn't do it in their first year. Like they actually lost like $50,000 in their first year, but they built it through 1, 2, 3 years of risking what? Of risking between 1 and 3%. Right? Mostly the trades that they have most amount of conviction in, that's when they are going to be risking more. If they have a little bit less conviction, then they are going to be risking less. And that is completely fine in terms of risk management, especially if you are an advanced trader. You probably already know your strategy well enough to be able to know when to risk 1% and when to risk 3%. But growth, once again, you're not really thinking about the track record. You're not really thinking about that consistency. You're thinking, okay, I'm a consistently profitable trader. I'm an advanced trader. I want to make my money work, right? These $1,000 or these $10,000, I know I'm not going to blow it by risking 1 to 3%. So let me go at it, right? That is what the 1 to 3% is for. But once again, it is catered to advanced traders, because of the likelihood of drawdowns and the fact that only an advanced trader or intermediate trader is able to cycle through and seeing minus 10% and be like, okay, I don't mind. I know I'm profitable. I'm able to get out of this. And so if you want to grow your account long term, if you want to make those $10,000 into $100,000 in a couple of years, then sure, I do believe that there's a point to be risking 1 to 3%. Now, if your goal is to have consistency and a track record, then you should be risking 1% just like the beginner. Because again, I've talked to the institutional side. I've talked to traders that have investors. I've talked to traders that have flipped accounts. So I've seen everything play out. And those are very, very different type of people that you are talking with. So once again, the people that are risking 1 to 3%, they could care less about having a track record to show to investors and then do the same with their capital. Believe me, they don't want to be risking 1 to 3% with investors' capital. But their goal, when your goal is to attract investors or attract brokers to get clients to invest in you, like do PAM or do a MAM, which is basically you're managing other people's capital, then the main thing that investors are looking for is how much drawdown is this trader incurring to get these amount of returns. Because believe me, a trader that has a maximum of 2% drawdown and makes 10%, he actually has a way better ratio than a trader that has 20% drawdown and makes 50%. You are way more likely to attract investors with the first case where you only made 10% versus someone that made 50% but had way bigger drawdown. Why? Because when you show the big drawdowns to investors, they get scared because it's like, what is going to happen to my money if this drawdown is not only 20%, but it's 60, 70, 80? They want to see less volatility. And that's why when you are trading and your goal is to attract the investors, attract by having a good track record, your goal should be 1% risk. You shouldn't be risking much more than 1%. And then just making sure that you consistently grow the account over and over again. You don't have big drawdown periods, or if you do, you don't see erratic behavior. Your goal is to consistently grow the account and make sure that at the end of 2 years, you have consistent quarters to show for, okay, I've been profitable, I've been profitable, I've been profitable, I've been profitable, right? So with that being said, this is really the best risk management that you can have when it comes to your personal account. Believe me, I've tried a lot of these things. I haven't done a lot of flipping. And now most of my goals are in prop firms and it's not really on personal account. Again, it is something that I will go for in the future, but for me, the number one thing that if I am going for a personal account, most of what I am going to be doing is going to the growth, risking 1 to 3%. Because again, I've also talked with people that manage investors' capital, and most of them are like, I'm just excited to go into my personal capital. And I'm like, God damn, then why are you not with prop firms? But yeah, so depending on your goals, this is definitely the risk management that you should be going for. And once again, one word of caution. Don't think that you're coming into trading and you're going to flip an account. I had a question this weekend on a Q&A, which was like, okay, how do I grow? Can I grow $20 into $1,000? And I was like, the best way to grow $20 to $1,000 is by getting a job, right? Because again, the likelihood of you being able to flip an account is very, very low, especially if you are a beginner. And I don't want you to have a bad experience with trading. I don't want you to be part of the statistics of 90% of traders fail. Why do you think that this video is all available on YouTube and on a free course? Is because I want the most amount of people to watch this and then be able to say, okay, I am not going to go this route that all of these traders that eventually fail go for. I want to listen to this trader that has been trading for 5 to 6 years, has been doing it consistently, never blew a personal account, and now is able to live off of trading. So it's extremely important that if you want to become a consistently profitable trader, if you have big goals, you need to cater your risk management to those goals. So once again, this is a great lesson on what investors look for and how to compound your account if your goal is growth. And again, if you are a beginner, just focus on consistency and making sure to prove to yourself that you are a consistently profitable trader. So I hope you guys enjoyed, and I'll see you tomorrow. Peace. Hope you enjoyed this lesson. Click right here to watch the next one. And if you are struggling with overtrading, then click right here to check out Trade Blocker. Peace.